Ladies and gentlemen, welcome to my channel. I want to begin with a simple truth. Most people underestimate the power of risk because they only see the upside. They hope to double their money quickly, but ignore what can go wrong. What if I told you there is a framework, a holy grail of investing, that allows you to double your money without exposing yourself to ruinous risk? Tonight, I will share with you how I've seen this done, how you can combine discipline, diversified bets, and understanding how the economy works so that your upside can flourish even when the world is volatile. Diversification with uncorrelated return streams is one of the most powerful yet misunderstood principles in the world of investing. Most people think diversification simply means owning a lot of different things, maybe a few stocks, some bonds, and perhaps some real estate. But that's not true diversification. It's often just a collection of correlated risks. Real diversification comes from combining investments that don't move in the same direction at the same time. When one zigs, the other zags. When one part of the portfolio suffers, another holds steady or rises. That interplay is what creates stability and allows compounding to work its magic over the long run. Think of it this way: if you hold a basket of assets that are all tied to the same drivers, then you're not really diversified, you're just concentrated in a disguise. For example, many investors believe they're diversified because they own shares of multiple technology companies, but in reality, those companies are all exposed to the same cycle of innovation, interest rates, and consumer demand. If the sector suffers, the entire portfolio suffers. True diversification means going beyond sectors, beyond asset classes, and beyond geographies to find streams of return that are truly independent of one another. The key lies in correlation, which measures how two investments move in relation to each other. If two assets have a correlation of 1, they move in perfect sync. If their correlation is 0, their movements are completely independent. If their correlation is negative, one tends to rise when the other falls. By combining streams of return that are not strongly correlated, an investor can reduce the overall volatility of their portfolio without necessarily sacrificing return. In fact, because volatility compounds negatively, losses hurt more than equivalent gains help. Reducing risk often allows the same returns to compound into greater wealth over time. Consider a simple example. Imagine you invest in stocks that tend to do well when the economy is growing. You also hold bonds that perform better when the economy slows and interest rates fall. Separately, each asset class has its own risks and periods of underperformance. But combined, they smooth each other out. When stocks decline in a recession, bonds may rally. When bonds lag during an economic boom, stocks may soar. Together, they create a more consistent and reliable return stream. That's the essence of uncorrelated diversification, not just holding many things, but holding the right mix of things. The concept extends far beyond just stocks and bonds. Within equities, you can seek exposure to different regions of the world. Emerging markets, developed markets, or frontier economies that respond differently to global trends. Within commodities, energy, agriculture, and precious metals often behave differently depending on whether inflation, supply shocks, or geopolitical risks dominate the environment. Real estate, infrastructure, private credit, and other alternative assets can add further uncorrelated streams. The more independent sources of return you add, the more stable the overall portfolio becomes. But it's important to note that uncorrelated return streams are not easy to identify, and correlations are not fixed forever. They change depending on the environment. Assets that looked uncorrelated during one decade might suddenly move together in a global crisis. For instance, in times of extreme panic, investors often sell everything to raise cash, creating temporary spikes in correlation. That's why the principle of diversification must go hand in hand with understanding the underlying drivers of each return stream. If you know what economic forces drive a particular investment, you can better judge whether it truly behaves independently of the others in your portfolio. The beauty of this approach is that it allows you to lower your overall risk without lowering your return. In fact, if you have enough uncorrelated return streams, your portfolio can achieve the same or even higher expected return with much less volatility. Mathematically, the risk reduction from combining independent return streams grows as you add more of them, though with diminishing marginal benefits after a certain point. In practice, even holding 10 to 15 well-chosen uncorrelated streams can make an enormous difference compared to holding only a few concentrated bets. This idea has profound implications for how we think about wealth building. Most people chase returns by trying to pick the next hot stock or timing the market, but that usually leads to disappointment because those strategies rely heavily on being right about an uncertain future. A better path is to structure a portfolio where you don't need to be right about everything, because you've prepared for multiple possible outcomes. If inflation rises, one set of assets helps you. If growth slows, another set cushions the blow. If the world surprises you, as it inevitably will, your portfolio is not destroyed because you didn't stake everything on a single scenario. That peace of mind is worth as much as the returns themselves. Ultimately, diversification with uncorrelated return streams is not just a technical trick. It's a way of thinking about risk and resilience. It reflects humility and acknowledgement that the future is uncertain and that no one can predict it with perfect accuracy. By spreading your bets intelligently across streams that truly behave differently, you create a portfolio that doesn't just aim to grow, but is designed to survive and thrive through whatever storms may come. It is this principle that transforms investing from gambling into something closer to engineering, designing a system that works reliably under pressure. And when that system is in place, doubling your money is no longer a matter of luck or timing. It becomes the natural result of compounding returns over time with much less risk of catastrophic loss. Most investors are naturally drawn to the allure of high returns. It is almost instinctive to look at the stock or fund that has doubled in value over the last year and imagine the same happening for us if we just buy it today. The problem with this mindset is that it focuses only on the reward while ignoring the risk taken to achieve it. Chasing returns without considering the risks involved is like driving a car at maximum speed without checking whether the brakes work. The smarter approach is to evaluate investments on the basis of risk-adjusted returns, how much return you are likely to receive for every unit of risk you take. Risk-adjusted return is essentially a measure of efficiency. It tells you not just how much money you might make, but how much danger you expose yourself to in order to make that money. An investment that offers 15% annual return with huge swings and a high probability of losing half your capital during a downturn may actually be less attractive than an investment that offers 8% return with very stable performance and limited downside risk. Over time, the latter can lead to greater compounded wealth because it protects you from devastating losses that take years to recover from. Remember, if you lose 50% of your capital, you need a 100% gain just to get back to where you started. Avoiding those kinds of drawdowns is critical. This is why professional investors often talk about volatility, downside risk, and the Sharpe ratio, which compares excess return over a risk-free rate to the volatility of the investment. While these terms may sound technical, the underlying logic is simple. If two investments both yield 10%, but one achieves it with wild swings and the other with smooth stability, the stable one is superior because it allows compounding to work uninterrupted. Volatility may look harmless in theory, but in practice it creates stress, panic selling, and the destruction of wealth when investors abandon their plan at the worst possible time. Consider the story of two friends. One invests in a hot technology stock that soars 40% in a single year, while the other chooses a balanced portfolio of assets that grows 12%. At first, the one with the technology stock seems like a genius. But the next year, the tech stock crashes 60%, leaving him deep in the red. Meanwhile, the balanced portfolio quietly compounds another 12%. After 2 years, the so-called conservative investor is actually far ahead and with far less emotional turmoil. The lesson is clear. The path that looks slower and steadier often wins the race because it protects against catastrophic setbacks. Focusing on risk-adjusted returns also forces an investor to think in probabilities rather than certainties. High return opportunities are often accompanied by low probabilities of success, just like a lottery ticket. You could hit it big, but the odds are stacked against you. On the other hand, moderate return opportunities with a high probability of steady success provide a foundation that can reliably build wealth. By assessing risk-adjusted returns, you shift your focus from hoping for luck to relying on discipline and consistency. This principle also helps in portfolio construction. Imagine you're deciding between two assets, one with a high expected return but extremely volatile, the other with a moderate return but very stable. On their own, the stable asset may look less exciting, but when combined with other investments, it could improve the entire portfolio's efficiency by reducing overall volatility. That means the portfolio can carry more stable compounding power, even if each individual piece is not spectacular on its own. It's like building a strong team. You don't just need flashy stars, you need reliable players who show up every day and keep the system balanced. Psychology also plays a crucial role here. Most people overestimate their tolerance for risk. They think they can handle the swings until they experience them. When portfolios drop sharply, fear takes over and they sell at the bottom. By prioritizing risk-adjusted returns, you're building a structure that is easier to stick with emotionally, which means you won't abandon it in moments of stress. Discipline is worth more than short-term brilliance, and the way to stay disciplined is to avoid exposing yourself to unbearable risk in the first place. Over time, the compounding of safer, steadier returns far outpaces the intermittent booms and busts of chasing high returns. Even if the average annualized return of a risky strategy looks higher on paper, the real-world experience often leads to worse outcomes because of drawdowns, mistakes, and the human tendency to panic. By consistently aiming for the best returns per unit of risk rather than the highest possible raw return, you build a portfolio that grows more predictably, survives downturns, and ultimately accumulates greater wealth. In the end, the pursuit of wealth should not feel like gambling. It should feel like constructing a well-engineered system that can perform reliably through different environments. The measure of success is not how much you can make in a single year, but how much you can preserve and grow decade after decade. That is why risk-adjusted returns matter more than chasing the highest returns. They allow you to grow not only your capital, but also your confidence, your discipline, and your peace of mind. And that is the true foundation of lasting financial success. The economy often feels like a complex, unpredictable force that moves markets and affects everyday life in ways that seem mysterious. But beneath all the noise, it operates like a machine made up of parts, processes, and predictable patterns that repeat over time. Understanding this machine and its cycles is one of the most important keys to successful investing, because markets are not random. They are driven by the rhythms of credit, debt, productivity, and human behavior. By learning how these cycles work, you can prepare for both the booms and the busts, rather than being caught off guard by them. At the most basic level, the economy runs on transactions. Every time someone buys something, there is a buyer who gives money and a seller who provides a good, service, or asset. Multiply that across millions of people, businesses, and governments, and you have the economy. What allows more or fewer transactions to occur is largely tied to credit. When credit is easy to obtain, people borrow and spend more, businesses invest more, and the economy grows faster. When credit becomes expensive or scarce, spending slows, businesses cut back, and the economy contracts. This credit cycle is one of the central engines that drives the ups and downs of the machine. There are two major types of cycles to understand: the short-term debt cycle and the long-term debt cycle. The short-term cycle usually lasts around 5 to 10 years and is driven by central banks adjusting interest rates to balance growth and inflation. When growth slows, central banks lower rates to make borrowing cheaper, which stimulates activity. But when growth becomes too hot and inflation rises, they raise rates to cool things down. This creates the familiar pattern of expansions and recessions. Investors who pay attention to these shifts can better anticipate when risks are rising or when opportunities are emerging. The long-term debt cycle is less obvious, but even more powerful. Over decades, societies tend to build up more and more debt because borrowing allows people to live beyond their current means. At first, this borrowing boosts productivity and spending, but over time, debt levels grow faster than incomes, and eventually, the burden of paying back that debt becomes unsustainable. That's when you get a deleverage, periods where debt has to be reduced, often through defaults, restructuring, or inflation eroding its value. These long-term cycles can span 50 to 75 years, and they explain some of the largest economic upheavals in history, from depressions to financial crises. Another key driver of the machine is productivity growth. Unlike credit, which brings spending forward from the future, productivity represents real, sustainable improvements in living standards. Productivity grows when people learn, innovate, and use technology to produce more with less. While debt cycles create the ups and downs, productivity is the force that pushes the long-term trend upward. A society that invests in education, innovation, and infrastructure builds a stronger foundation, while one that relies too heavily on debt without boosting productivity eventually faces stagnation. Inflation and deflation are also critical parts of the machine. Inflation occurs when too much money and credit chase too few goods, driving prices up. Deflation happens when demand collapses or when too much debt causes people to cut spending, pushing prices down. Both extremes can be damaging. Inflation erodes purchasing power, while deflation increases the real burden of debt. Policymakers constantly try to balance these forces, but investors must understand that inflation and deflation shape the value of assets differently. For example, stocks and real estate tend to do well in moderate inflation, while bonds perform better in deflationary periods. Gold often acts as a store of value when inflation is high or confidence in paper money weakens. Global linkages add another layer of complexity. Today, economies are deeply interconnected, which means one nation's cycle can spill over into others. A slowdown in China affects commodity exporters. A policy decision by the U.S. Federal Reserve influences capital flows worldwide. Understanding the machine requires not only looking at your own country, but also how cycles interact on a global scale. For investors, recognizing where we are in the cycle is invaluable. Are interest rates rising or falling? Are debt levels sustainable or excessive? Is productivity growing strongly or stagnating? Are inflationary pressures building, or are we facing deflationary risks? By answering these questions, you can adjust your strategy. For instance, when the economy is in the late stage of expansion with high debt and rising inflation, risks are elevated and caution is warranted. When it is in recession but central banks are easing policy, opportunities to buy assets at low prices appear. Understanding the economic machine also cultivates humility. No one can predict the future with perfect accuracy, but by studying the patterns of history and the logic of cycles, you can narrow the range of possibilities and prepare for them. Instead of being surprised when a recession hits or when inflation spikes, you see them as normal parts of the cycle. You stop asking, "Why is this happening to me?" and start asking, "Where are we in the cycle, and how should I position myself?" Ultimately, the economy is not chaos. It is a system that follows rules and patterns. The people who thrive are those who study the machine, respect its cycles, and prepare for both the ups and the downs. By doing so, you are no longer a passive passenger being tossed around by economic storms. You become a navigator who knows where the tides are heading and can steer a steadier course toward lasting success. When most people think about investing, they focus almost entirely on how to grow their wealth, how to double their money, how to find the next big winner, or how to beat the market. But before chasing returns, the first step is to understand the purpose of the money and to make sure your essential needs and obligations are protected. This is what it means to immunize liabilities. It's about ensuring that the critical things in your life, your living expenses, your children's education, your retirement, your health, care are secured regardless of what happens in the markets. Once those obligations are immunized, only then does it make sense to take risk with the rest of your capital. Money is not an abstract number. It represents security, freedom, and the ability to meet life's needs. If you invest without knowing why you are investing, you run the risk of taking on too much exposure and jeopardizing things that should never be put at risk. For example, imagine you have money saved to pay for your child's education in 3 years. If you put that money into volatile stocks, hoping to maximize returns, and the market falls sharply, you may no longer be able to afford tuition when the time comes. That liability was not immunized. On the other hand, if you had placed that money in safe, stable assets, such as government bonds, fixed deposits, or even cash, you would have guaranteed the ability to fulfill that obligation, regardless of market conditions. The potential return might be lower, but the purpose of that money was not to grow aggressively. It was to be there when needed. This principle extends to retirement as well. Many people treat retirement savings as if it were just another pool of money to grow as large as possible. But the true purpose of retirement funds is to provide steady income and security in the later years of life. That means the first priority should be to cover essential living costs with assets that are safe and reliable. Once those baseline needs are protected, you can take additional risk with any surplus to potentially increase your lifestyle, but risking your core retirement needs in search of higher returns is a dangerous mistake. Immunizing liabilities also involves thinking carefully about the time horizon for each financial goal. Short-term obligations like tuition payments, mortgage installments, or upcoming medical expenses require assets that won't fluctuate wildly in value. Medium-term obligations might allow for a blend of safe and moderately risky assets, while long-term goals can tolerate more volatility because time smooths out short-term fluctuations. By aligning the type of asset with the timing and importance of the liability, you ensure that your money serves its intended purpose without exposing you to unnecessary danger. Another dimension is inflation. Immunizing liabilities doesn't only mean making sure the nominal value of money is there. It also means preserving its real purchasing power. A person might save enough today for retirement, but if all the money is kept in cash and inflation erodes its value over decades, the obligation will not truly be met. That's why balancing safety with growth is essential. For near-term liabilities, safety matters most. For longer-term liabilities, growth assets that outpace inflation become part of the solution. The psychological benefit of this approach is also powerful. When you know your essential obligations are immunized, you gain peace of mind. You no longer need to panic over every market downturn because you know the roof over your head, your food, your health care, and your loved one's security are not at risk. This reduces stress and allows you to make better investment decisions with the rest of your capital. Many bad financial decisions are made in fear when people realize too late that they put essential money at risk and scramble to recover. By immunizing liabilities from the start, you avoid that trap. Once the essentials are secured, you can approach the remainder of your portfolio with a different mindset. This is where you can pursue growth, seek diversification, and accept measured risks. If that money grows, it enhances your lifestyle, allows for luxuries, or creates opportunities for future generations. If it doesn't perform as well as hoped, it may be disappointing, but it won't threaten your ability to live securely. This separation between must-have money and can-risk money is one of the clearest ways to align your financial life with your real-world goals. Ultimately, knowing the purpose of your money transforms investing from a game of chance into a structured plan. It forces you to prioritize what truly matters: security, stability, and peace of mind, before chasing what is optional. Immunizing liabilities means building a foundation so strong that no storm in the markets can wash it away. From that foundation, you can pursue growth confidently, knowing that your essentials are untouchable. In this way, money becomes not just a tool for wealth, but a shield against uncertainty, serving the life you want to live rather than threatening it. One of the greatest challenges in investing is not the market itself, but the way human emotions interact with it. Markets go up and down, often in unpredictable ways, and those swings trigger powerful feelings of fear and greed. Fear tells us to sell when prices fall, locking in losses. Greed pushes us to buy more when prices soar, often just before a decline. These emotional reactions feel natural in the moment, but over time they destroy wealth. To succeed, it is essential to step away from emotional decision-making and instead rely on principles. Tested, rational, repeatable approaches that guide choices even when emotions run high. Human beings are wired for survival, not for investing. Thousands of years of evolution have taught us to flee danger at the first sign of threat and to seize opportunities when resources appear abundant. These instincts worked well when the threats were predators or scarcity of food, but in modern financial markets, they often backfire. A falling market is not a tiger in the jungle, yet it triggers the same fear response, causing investors to dump assets at the worst possible time. A booming market is not an unlimited food supply, yet it triggers greed, luring people into overpaying for assets near their peak. Recognizing this mismatch between instinct and reality is the first step to avoiding emotional bias. Short-term bias is another trap closely tied to emotion. People naturally place too much weight on what has happened recently. If a stock has gone up for the last 6 months, many assume it will keep going up. If it has gone down, they assume it will keep going down. This recency bias blinds us to the bigger picture. Markets move in cycles, not straight lines. What went up yesterday may be due to come down tomorrow, and what looks terrible today may actually be poised for recovery. Without discipline, investors get caught chasing the latest trend, buying high and selling low, all because they focused on the short term instead of the long term. The antidote to emotion and short-term thinking is principled decision making. Principles are like rules of the road. They prevent impulsive mistakes by setting clear guidelines for behavior before stressful situations arise. For example, a principle might be, always stay diversified, never put more than a certain percentage of wealth into one asset, or rebalance regularly regardless of market noise. Another principle might be, when the market falls by a certain percentage, instead of panicking, consider it an opportunity to buy at lower prices. These kinds of rules remove the guesswork in the heat of the moment, making it easier to act rationally rather than emotionally. Principled decision making also requires reflection and learning. Every investor makes mistakes. The difference between those who improve and those who repeat errors lies in whether they step back to analyze what went wrong. Did fear drive a premature sale? Did greed lead to overconfidence? By writing down principles and adjusting them over time, an investor creates a personal playbook that becomes stronger with experience. This process of continuous learning helps turn painful mistakes into valuable lessons that improve future decisions. Another powerful way to avoid emotional decision-making is to adopt a long-term perspective. If you know you are investing for 20 or 30 years, a short-term decline of 10 or even 20% becomes less frightening. You understand that downturns are temporary and often create the best buying opportunities. The long-term view also allows compounding to work in your favor, turning small, steady gains into significant wealth over decades. By focusing on the bigger picture, you can resist the temptation to overreact to daily headlines and market fluctuations. Principles also help balance risk and reward in a thoughtful way. Without principles, people tend to swing between extremes, either avoiding all risk out of fear or taking reckless risks out of greed. A principled approach defines acceptable risk levels in advance and sticks to them. For instance, you may decide that a certain portion of your portfolio will always be in safe assets to protect against downturns, while another portion will be in growth assets to capture upside. By following this framework consistently, you avoid wild swings in behavior that lead to regret. Finally, using principles over emotions cultivates peace of mind. Markets will always be uncertain, and no one can predict them perfectly. But knowing you have a disciplined process in place allows you to face uncertainty with confidence. You stop obsessing over every market move because you trust the system you have built. That calmness is itself an advantage because it keeps you from making hasty decisions that others will regret. In the end, the difference between success and failure in investing is often not intelligence, but discipline. Many brilliant people lose money because they cannot control their emotions. Meanwhile, ordinary individuals who stick to principles steadily build wealth. By avoiding emotion, resisting short-term bias, and committing to principled decision making, you give yourself a durable edge. You become less reactive, more consistent, and more resilient in the face of inevitable ups and downs. That consistency, over time, is what turns investing from a stressful gamble into a reliable path toward financial freedom. If you follow this formula, knowing your purpose, diversifying your bets, studying cycles, balancing risk and return, and being brutally honest with yourself about mistakes, you won't just chase doubling your money. You will earn doubling your security, your confidence, and your freedom. Because with low risk, you don't bet your future on whims. You build it. So I encourage you, commit to a principled approach. Commit to learning, not speculating. And in doing so, you might not just double your money. You'll double your peace of mind. Thank you.